Welcome back, finance fans. Let us continue this second segment of compliance. Mandatory AML compliance programs. All broker-dealers are now obligated to establish anti-money laundering (AML) compliance programs, which at a minimum must include policies and procedures are expected to detect and report suspicious transactions, thereby deterring money laundering, the appointment of a compliance officer responsible for the firm's AML program. There is no requirement for this individual to be FINRA registered. A continuous employee training program. An independent audit function to assess the effectiveness of the firm's AML program. Industry regulations also mandate that AML programs be documented in writing and receive approval from a member of senior management. The independent audit function, sometimes referred to as a stress test, must be performed annually unless the member firm does not engage in transactions for customers or hold customer accounts. For example, it is a proprietary trading firm. In such cases, the stress test is only required every 2 years on a calendar year basis. Customer Identification Program, CIP. As part of their AML compliance program, broker-dealers must establish a customer identification program to verify the identity of any individual seeking to open an account. Firms are also required to keep records of the information used to verify a person's identity and to determine whether the person is listed as a known or suspected terrorist or affiliated organization. Specially designated nationals and blocked persons list. Firms and their representatives must ensure that they're not doing business with anyone whose name appears on a list maintained by the Treasury Department's Office of Foreign Assets Control, OFAC. This list is known as the Specially Designated Nationals and Blocked Persons List, or simply the SDN list. The SDN list identifies known and suspected terrorists, other criminals, as well as nations that are deemed pariahs, for example, Syria and Iran. Conducting business with any of these individuals or entities is prohibited. If a firm discovers that one of its clients appears on the SDN list, it must block all transactions immediately and inform federal law enforcement authorities. Broker-dealers are required to exercise special due diligence when opening private banking accounts for foreign nationals. They are also prohibited from maintaining correspondent accounts for foreign shell banks, that is, banks that do not have a physical presence in any country. Customer verification. A broker-dealer must verify a customer's identity within a reasonable time frame before or after the customer's account is opened. Under the new regulations, the following minimum information must be obtained from a customer. Name, date of birth for individuals, not businesses. Address. For individuals, this must be a residential or street address. For corporate accounts, it must be the principal place of business or a local office. An identification number. For U.S. citizens, taxpayer ID number. For example, Social Security number or employer identification number. For non-U.S. citizens, taxpayer ID number, passport number, and country of issuance, alien identification card number, or government-issued identification showing nationality, residence, and a photograph. A broker-dealer may use documentary methods, for example, driver's license or passport, or non-documentary methods, for example, references from other financial institutions or consumer reporting agencies, to verify a customer's identity. Taxpayer ID. Exception. A broker-dealer who receives an application to open an account may waive the obligation to obtain a taxpayer ID number if the person has applied for it, but has not yet received the number. However, instead of the number, the broker-dealer must retain a copy of the taxpayer identification application. Record retention. Under the CIP rules, a broker-dealer must maintain records of the methods used to verify a customer's identity for 5 years following the closure of the account. Penalties. To discourage money laundering activities, the penalties for violating existing AML laws are severe, including potential incarceration and fines. Under criminal law, a registered representative found guilty of facilitating money laundering may be sentenced to 20 years in prison and fined up to $500,000 per transaction, or twice the amount of the funds involved, whichever is greater. Registered representatives do not need to have knowledge of a money laundering scheme or even participate in it to be prosecuted. Instead, registered representatives and their firms may be held liable for being willfully blind to the activity. SEC Regulation SP, Privacy of Consumer Financial Information. In November 1999, the Gramm-Leach-Bliley Act was enacted to require institutions engaged in certain financial activities to 1. Establish privacy policies concerning information they collect from and about their customers, 2. Notify customers of those privacy policies, and 3. give customers the right to opt out of any disclosures of their non-public personal information to certain third parties. That is, customers may instruct the financial institution not to disclose their information to unaffiliated third parties. The SEC adopted rules to enforce these privacy requirements under Regulation SP, which applies to all broker-dealers, investment companies, and SEC-registered investment advisors. Confidentiality requirements and safeguard requirements. To protect customer records and information, every broker-dealer must adopt policies and procedures to physically safeguard these records and information. These policies must ensure the security and confidentiality of customer records and information, protect against anticipated threats or hazards to the security or integrity of customer account records, and guard against unauthorized access to or use of customer records or information that could cause significant harm or inconvenience to any customer. Scope of information that must be protected. Remember, Regulation SP protects a customer's non-public personal information, including information obtained from the customer or from customer lists created from personally identifiable information, that is, personal financial and account information. However, the disclosure of publicly available customer information is not restricted under this regulation. Publicly available information consists of what is lawfully accessible to the general public from official records, information from widely distributed news media, for example, generally accessible websites or newspapers, and information that federal, state, or local law mandates be disclosed to the general public. Privacy notice. Under Regulation SP, firms must provide their customers with a description of their privacy policies, a privacy notice, at the time of account opening and annually thereafter. Among other things, these privacy notices must outline the types of personal information that the firm collects, along with the categories of both affiliated and unaffiliated third parties to whom the information may potentially be disclosed. The timing of the notice depends on the client's relationship with the firm. Regulation SP divides clients into two categories: consumers and customers. A consumer is a person who is in the process of providing information to the firm related to a potential transaction. A customer is a person who has an ongoing relationship with the firm. For instance, if John meets with a financial advisor from ABC Securities about establishing a financial plan, he is considered a consumer, a potential customer. However, once John opens an account with ABC Securities, he becomes a customer. For consumers, a firm must provide a privacy notice before disclosing non-public personal information to any unaffiliated third party. However, if the firm does not intend to disclose any consumer information to an unaffiliated third party, providing a notice is not required. For customers, a firm must initially provide a privacy notice when the relationship is first established. Thereafter, it must follow up with a revised version of this notice annually. The notice must inform consumers/customers that they have the right to opt out of having their information shared with unaffiliated third parties and explain the process for opting out. The method used by a broker-dealer for opting out must be reasonable. Acceptable methods include electronic responses or a toll-free phone number for customers to call. However, requiring a customer to write a letter is considered unreasonable. Identity Theft Prevention (FTC) Red Flags Rule. The Federal Trade Commission's FTC Red Flags Rule requires many financial institutions, such as banks and broker-dealers, to create and implement a written identity theft prevention program. Each firm must establish policies and procedures that address the appropriate actions to take when identity theft is suspected and/or detected. The intent of the rule is to help firms quickly identify suspicious activities, red flags, to prevent the theft of their clients' assets. The policies and procedures found within these programs must be referenced in a firm's written supervisory procedures documentation. Use of stockholder information for solicitation. As indicated by Regulation SP and the FTC rule, firms and their registered representatives are responsible for protecting their clients' information. This requirement raises an important question. Can a firm acting as a trustee for a corporation use a shareholder list to cold call or prospect for other matters? Generally, this practice violates industry rules. SRO rules prohibit a trustee from using stockholder information for solicitation purposes unless the member firm is specifically directed to do so by and for the benefit of the corporation. Client notifications. Once an account is opened, broker-dealers must provide the client with information, including trade confirmations, statements, and other miscellaneous mailings, The SEC mandates the frequency and timing of the delivery of this information, account statements, and other notifications. Broker-dealers must provide customers with account statements at least quarterly. Most firms offer monthly statements for any accounts that have activity. At a minimum, the account statement must contain a description of all security positions, all money balances, all account activity since the last statement. Account activity includes purchases, sales, interest credits or debits, charges or credits, dividend payments, transfer activity, securities receipts or deliveries, and/or journal entries related to securities or funds in the possession or control of the broker-dealer. Confirmation statements. The SEC requires broker-dealers to provide customers with a detailed confirmation of each purchase or sale. This confirmation must be sent at or before the completion of any transaction, typically the settlement date. The confirmation should include the following information: the identity and price of the security bought or sold, the number of shares, units, or principal amount, the date of the transaction and the time of execution, or a statement that the time will be provided upon written request, the capacity in which the broker-dealer acted, such as agent for the customer, agent for another person, agent for both the customer and another person referred to as a cross, principal for its own account, the commission, markup, or markdown for the transaction calculated in compliance with applicable rules and expressed as a total dollar amount and as a percentage of the prevailing market price, the dollar price and yield information on debt securities, whether a security is callable, along with a statement that further information will be provided upon request, the settlement date. Even if a registered representative, RR, has discretion over a customer's account, confirmations for all transactions must be sent to the customer. Statements and trade confirmations may also be sent to an investment advisor or other third party, but only if written consent from the customer is obtained. Holding of client mail. A firm may hold mail for a customer who will not be receiving it at their usual address, provided the firm receives written instructions from the customer that include the time period during which the mail will be held. If the period requested exceeds 3 consecutive months, the customer's instructions must include a valid reason for this request. However, convenience is not considered a valid reason for this type of request. Provides written disclosure to the customer regarding alternative methods available to monitor the account, for example through email or the firm's website. At reasonable intervals, verifies that the customer's instructions still apply. During the period when a customer's mail is being held, the firm must also ensure that the mail is not tampered with, held without the customer's consent, or used by any associated persons in a manner that violates securities laws. Electronic delivery of client records. All account records, including confirmations, statements, and tax reporting information, may be delivered to the client electronically. According to SEC rules, providing client access to the records equates to delivery. Essentially, if a client decides to receive electronic documents, there's no need to follow up with paper copies. Some firms may charge customers a nominal processing fee for having confirmations processed in paper format. Regulation of communications. FINRA categorizes communications with the public into 3 types: correspondence, institutional communications, and retail communications. Correspondence is defined as written or electronic messages that a member firm sends to 25 or fewer retail investors within any 30 calendar day period. Typical delivery methods include physical paper letters, text messages, and email. Institutional communication encompasses any written or electronic communication distributed or made available only to institutional investors, banks, savings and loans, insurance companies, registered investment companies, and registered investment advisors, government entities and their subdivisions, employee benefit plans such as 403 EB and 457 plans, and other qualified plans with at least 100 participants, broker-dealers and their registered representatives, individuals or entities with total assets of at least $50 million. Under FINRA rules, a member firm must establish policies and procedures to prevent institutional communications from being forwarded to retail investors. One acceptable method is to include a legend on the communication stating, "For use by institutional investors only." If a member firm becomes aware that an institutional investor is making institutional communications available to retail investors, The firm is required to treat future communications to that institutional investor as retail communications. Retail communication is defined as written or electronic communications that are distributed or made available to more than 25 retail investors within a 30 calendar day period. A retail investor is any person who does not meet the definition of an institutional investor. All materials prepared for public media, where the ultimate audience is unknown, are considered retail communications. This includes television, radio, and billboards, magazines and newspapers, certain websites and online interactive electronic forums such as chat rooms, static blogs, or social networking sites, telemarketing and sales scripts. Independently prepared reprints sent to more than 25 retail investors. Email sent only to registered investment advisors is classified as institutional communication. Email sent to 25 or fewer retail investors is considered correspondence. Finally, email sent to more than 25 retail investors is classified as retail communication. Social media sites fall under the requirements of a public appearance, and certain disclosures may be necessary. Since firms may be unable to monitor their registered representatives' activities on these platforms, most firms do not allow their representatives to use them for communicating with customers or conducting business. Approvals. Correspondence and institutional communications must be supervised and reviewed by the brokerage firm. However, they do not require approval. Unless an exception applies, retail communication must be approved by a qualified principal supervisor of the firm. Additionally, certain types of retail communication, for example, those relating to options and mutual funds, must also be filed with FINRA. To avoid overwhelming you with long videos, we'll keep it brief and easy to digest. Join us for a follow-up video where we will continue the discussion from this one. As always, please like this video so others can benefit as well. If you are a new viewer, welcome. And we invite you to join our family with a free subscription.